32%. That is how much more money lands in your account every single month for the rest of your life. If you know about one specific action you can take at the SSA, most retirees never hear about it. The people at the SSA window are not required to explain it to you. And by the time most folks figure it out, they have already left money on the table that they will never get back. I am going to show you exactly what this is, how it works in 2026, and what you need to do this week. Stay with me. My name is William Hayes. I have spent more than 20 years helping retirees claim Social Security correctly and recover money the SSA never told them they were owed. I am an enrolled agent. I work with seniors on taxes and benefits. Not for the government, not for a brokerage, for retirees. Over the years, I have sat across the kitchen table from hundreds of people who did everything right, worked 40 years, paid into the system every single paycheck, and still walked away from thousands of dollars because nobody at the agency took the time to explain the math. That is what this channel is for. If you are 55 or older and you have questions about Social Security, Medicare, or how your retirement income gets taxed, this is where you need to be. Hit the subscribe button. I put out new videos every week, and each one is built around the exact kind of information the agencies are not handing you voluntarily. Now, let me tell you about the 32%. Before I give you the real numbers, I want to talk about two things I hear constantly. Two pieces of advice that get passed around retirement communities like they are gospel. The first one: claim as early as possible. Get your money now. You paid into it, you deserve it, and who knows how long you have got. I understand that thinking. It is not crazy. But it is not a strategy. It is a feeling. And feelings do not pay the electric bill at 83. When you claim at 62, you lock in a permanent reduction of up to 30% below your full benefit. That reduction does not go away when you turn 67. It does not get recalculated. You carry it for life. For someone receiving the current 2026 average benefit of roughly $1.976 a month, claiming early at 62 could mean receiving closer to $1.400 every month, every year. The second myth: I cannot afford to wait. I need the income now. That one I take seriously, because for some people it is genuinely true. If you have a serious health condition, a shorter life expectancy, or you have no other income and you need money to keep the lights on right now, claiming early may be the right call for your situation. I am not here to tell you otherwise. But I am here to tell you that most people who say they cannot afford to wait have not actually run the math. They have not looked at the break-even point. They have not considered what a part-time income for a few more years would mean for their lifetime Social Security total. And they have almost certainly never heard of the voluntary suspension option, which I will get to in a few minutes. So before you decide you cannot afford to wait, let me show you what waiting actually buys you. Here is how the math works. Gov. If you were born in 1960 or later, your full retirement age is 67. That is the age at which you receive 100% of your calculated benefit, your primary insurance amount, now. For every month you wait past 67, the SSA adds a delayed retirement credit to your benefit. That credit is 2/3 of 1% per month. 12 months times 2/3 of 1% equals 8% per year. You can earn those credits from age 67 up to age 70, not past 70. At 70, the credits stop. There is no benefit to waiting beyond 70. None. But from 67 to 70, 3 years times 8% equals 24%. Wait, the job title says 32%. How do we get there? 4 years. For people born before 1960, whose full retirement age is 66, delaying from 66 to 70 is 4 full years. 4 times 8% equals 32%. That is the maximum. For people born in 1960 or later, full retirement age 67, the window is 67 to 70, which is 3 years, which is 24%. Still substantial, still life-changing. But here is where it gets important. That increase is permanent. It is not a bonus. It is not a temporary adjustment. Every month for the rest of your life, your check reflects that higher base. And when the SSA applies a cost of living adjustment, the COLA, it applies it to that higher base. So the gap between the person who delayed and the person who claimed early widens every single year. 8%. The maximum Social Security benefit for someone who waited until 70 is now $5.181 per month in 2026, according to published figures. For someone who claimed at 67, the maximum is $4.207. That is a difference of nearly $974 a month, more than $11,020 a year. Those are maximum earner numbers. Your numbers will be different, but the percentage gap is the same regardless of your benefit level. Now, there is one more piece to this that I need you to understand before we talk about what happens if you have already claimed. Your spouse, or your surviving spouse. When you delay and build up those delayed retirement credits, your eventual monthly benefit is higher. When you pass away, your surviving spouse can claim a survivor benefit based on your record. If your benefit is higher because you delayed, the survivor benefit is also higher. That means the decision to delay or not to delay does not just affect you. It affects the person who may be living on your Social Security income after you are gone. This is not a small thing. For many couples, the higher earning spouse's record becomes the foundation of the surviving spouse's retirement income for decades. And the credits stop at 70. No benefit past 70. Confirm with the SSA for your specific situation. But the inheritance of that higher base to a surviving spouse, that does not stop. Now I want to introduce you to a woman I will call Carol. That is not her real name. This is a composite drawn from situations I have seen across the years. Carol lives in Columbus, Ohio. She is 66 years old. She worked as a school administrator for 31 years. She retired early and has been living on savings. Now she is trying to decide whether to claim Social Security at 67, her full retirement age, or wait until 70. Her calculated benefit at 67 is $2.140 a month. That is her primary insurance amount based on her earnings record. If Carol claims at 67, she gets $2.140, 12 months a year, for every year she lives. If Carol waits until 70, she earns 3 years of delayed retirement credits at 8% per year. That is 24% added to her base. 60. Her monthly benefit at 70 becomes approximately $2.654. The difference is $514 a month. $6.168 a year. Now, the break-even question. Carol gives up 3 years of payments, roughly $77.040 in total, by waiting from 67 to 70. How long until the higher monthly payment makes up for what she missed? At $514 extra per month, she recoups that $77.040 in approximately 12 and a half years. She would reach break-even around age 82 and a half. The average American woman reaching 65 today has a life expectancy pushing 87. If Carol lives to 87, she collects the higher benefit for 17 years past age 70. 17 years times $6.168 a year is more than $104,000 in additional lifetime income. That is what the math looks like, not Gov. Her situation is hers, but the framework is real. Now, what if you already claimed? What if you are 68 and you started taking Social Security 2 years ago? And you are watching this video thinking it is too late. It may not be. There are 2 options I want you to know about. The first is withdrawal of application. This applies if you claimed within the last 12 months. If you claimed recently and have not passed 12 months yet, you can file Form SSA-521, the request for withdrawal of application, and cancel your claim entirely. If the SSA approves it, your claim has no legal effect. You start clean. You repay any benefits you received, and then you can refile later at a higher amount. This option is available once in a lifetime. It is not widely advertised. The SSA does not walk you through it. You have to ask. The second option is voluntary suspension. This is for people who have already claimed and are past the 12-month withdrawal window, but who have not yet reached 70. If you are at full retirement age or older and you are currently receiving benefits, you can contact the SSA and request to voluntarily suspend your payments. You do not need a specific form. You can do it in writing or by phone. Once suspended, your benefit stops. But for every month it is suspended, you accumulate delayed retirement credits, the same 2/3 of 1% per month. Your benefit restarts automatically at 70 at the higher rate. Or, you can request reinstatement at any point before 70. This is the retroactive lever that most people never use. If Carol had already claimed at 67 and then learned about this at 68, she could suspend for 2 years, earn 16% in additional credits, and restart at 70 with a meaningfully higher check. One more thing on retroactive. At full retirement age, if you have not yet claimed, you can request up to 6 months of retroactive benefits as a lump sum. That means if you turn 67 in January and you wait until July to file, you can ask the SSA to pay you the 6 months of back payments you did not collect. You do not get delayed retirement credits for those 6 months. You traded the credits for the lump sum. But the lump sum is real money in your pocket right now, and for some people the math favors taking it. That decision has to be made carefully based on your age, health, and income needs. Confirm your own situation with the SSA, but know the option exists. It does. Here is what I want you to do this week. Not next month. This week. Step 1. Dari Kaminte's Age Korai Way, and create a My Social Security account if you do not have one. It takes about 15 minutes. Once you are in, pull up your Social Security statement. You will see your estimated benefit at 62, your full retirement age, and your benefit at 70. Look at those 3 numbers side by side. The difference between the age 70 number and the full retirement age number is your delayed retirement credit opportunity. Write it down. Step 2. Do the break-even math. Take the difference in monthly benefits between claiming now and claiming at 70. Divide the income you would give up by weighting into the monthly gain. That gives you your break-even age in months. If you are in reasonably good health, and your break-even is before your mid-80s, delaying is almost always worth considering. Step 3. Call the SSA at 1-800-772-1213. When you get a representative, use these exact words. I want to ask about my delayed retirement credits and whether a voluntary suspension of benefits makes sense in my situation. Write down the name of the person you speak with and the date. The SSA does not always document calls the way you would hope. Keep your own record. Step 4. If you claimed within the last 12 months and you want to explore withdrawing your application, ask specifically about Form SSA-521-Gov. You can also request it mailed to you. You have 12 months from your original claim date. Do not let that window close without at least knowing your options. Step 5. If you have a spouse, have this conversation together. The decision about when to claim affects both of you, not just today, but for the rest of your lives and potentially beyond. You do not have to figure this out alone. But you do have to figure it out. The SSA is not going to do it for you. This is general education, not personal legal, tax, or financial advice. These rules really do vary by state and by income. Always confirm your own situation with your county, your state SHIP office, the IRS, or a qualified professional before you act. Being legally entitled and actually having the money are 2 different things. The only bridge between them is the form, and the agencies are not going to build it for you. So we will. Share this video with someone you know who is within 5 years of retirement. They may not know this exists. In the next video, I am going to show you the one form you can file at your local SSA office, not online, at the office, that has recovered tens of thousands of dollars in back pay for retirees who were underpaid for years and never knew it. That video is next.